Investing in initial public offerings (IPOs) can seem like a lucrative opportunity to get in on the ground floor of the next big thing. The buzz surrounding these market debuts often creates a sense of urgency and excitement. However, beneath this shiny surface lies a plethora of risks that may outweigh potential rewards, making it wiser to avoid diving into IPOs without thorough consideration. First and foremost, IPOs are often overhyped by underwriters and media, creating inflated expectations. This hype can lead to a significant disparity between the initial offering price and the true market value of the stock. Investors may find themselves paying a premium for shares that could quickly plummet once the initial excitement wanes and the market starts scrutinizing the company's fundamentals more closely. Moreover, the companies going public often lack a proven track record. While seasoned companies have historical data, earnings statistics, and performance metrics to rely on, many IPOs are about brands and businesses still making their mark. Investing in such companies is akin to venturing into uncharted waters without a map. The lack of tangible financial information makes it difficult to make informed decisions, heightening the risk of investment losses. IPOs are also notorious for their volatility. The prices of newly issued stocks can fluctuate wildly in the first few days or weeks of trading. This roller coaster effect can be driven by market speculation, investor sentiment, or news events, making it challenging to predict and manage investment outcomes. For risk-averse investors or those unfamiliar with market dynamics, this volatility can result in substantial financial losses. Another critical aspect to consider is the lockup period often imposed on company insiders. During this time, insiders, including founders and early investors, are prohibited from selling their shares. Once the lockup period expires, a flood of shares may enter the market, potentially driving the stock price down. This adds another layer of uncertainty and risk for those who bought shares at the IPO price, anticipating a steady rise in value. Furthermore, the allocation process during an IPO can be disadvantageous to retail investors. Institutional investors, who often receive preferential treatment, may get a more significant share of the allocation, leaving small investors with fewer shares or none at all. This can lead to disappointment and missed opportunities, particularly when the demand for the IPO is high. Given these considerations, it is prudent for individual investors to approach IPOs with caution. Instead of succumbing to the allure of getting in early, one could benefit from waiting until the market has had time to assess the true value of the stock. By doing so, investors can make more informed decisions, reducing the likelihood of expensive mistakes and increasing the chances of achieving stable, long-term returns.